Today, we're going to tackle a question that, let's be honest, drives pretty much every trader crazy. Why do prices always seem to snap back like a rubber band right after you've made your move?
So this is the central mystery, right? You see price moving, you think, okay, this is it. But then, bam, it zips right back to where it started. It feels totally chaotic. But what if I told you it's actually one of the most logical things the market does?
This scenario. I mean, come on, we've all been there. It's that classic soul-crushing moment that is so precise, it feels personal. It makes you think the market is either completely random or, even worse, it's actively out to get you.
But what if it isn't personal? And what if it isn't random? What if you just thought about the market as a very, very efficient machine that's just looking for fuel to get where it needs to go? Let's dive into this first piece of the puzzle, the hunt for liquidity. So to really get these weird market movements, you have to understand the one thing the market is always searching for, and that's liquidity. The best way to think about it is like gasoline. It's the fuel that makes the entire market engine run. Without it, the really big players, we're talking institutions with billion-dollar orders, they simply can't make a move. Okay, so if these big guys need massive amounts of this gasoline to fill their huge orders, where do they find it? You'd think it'd be hidden in some secret vault, right? Well, what's so interesting is that it's not hidden at all. It actually gathers in very obvious, very predictable places. It pools up in the exact same places millions of retail traders are taught to place their orders. You know, every single stop-loss order sitting just below a support level. Every buy-stop order waiting just above a resistance level. They all just sit there, creating these giant, concentrated pools of orders. And this, right here, shows you the two completely different ways of looking at the same thing. What you're taught is a safe zone, a logical spot to protect your capital. Well, to an institution, that's a fuel station. It is the most efficient place for them to go to fill up their massive orders without causing the price to slip away from them. It's nothing personal, it's just pure mechanical necessity.
So what many of us call a stop hunt is really just a liquidity sweep. Think about it. It's a cold, mechanical process. An institution needs to buy a ton of something, so their algorithms push the price down just far enough to trigger all those sell stops hiding below support. That creates a huge flood of selling, which they happily buy up to fill their own order. And once their order is full, that downward pressure vanishes and the price snaps right back up.
Okay, so that explains the hunt for fuel. That makes sense. But what about the other half of this mystery? Why does price so often come back to levels it just aggressively rocketed away from? Well, this brings us to the second key idea, what I like to call the market's echo. I want you to picture those huge, powerful candles that just shoot straight up or straight down. You know the ones, maybe from a liquidity sweep or some big news event. They happen so fast, so aggressively, that they leave behind a kind of digital footprint, an area of inefficiency. And that footprint, it actually has a name. It's called an imbalance, or a fair value gap. All it means is that it's a part of the chart where business wasn't done properly. It was all one-sided, all buyers and no sellers, or all sellers and no buyers. It's basically unfinished business that the market needs to come back and take care of. Now, this is so important to get. The market isn't just a random number generator. At its core, it's a machine, and its fundamental job is to facilitate trade between buyers and sellers. When a move is too fast and too one-sided, that job fails, and the machine will almost always try to go back and correct itself. So here's the key takeaway on this. That return trip, that pullback, it's not a random reversal designed to trick you. Not at all. It is a necessary process. The market is just going back to that messy, imbalanced area to rebalance the books, to get the trades done that it missed on the way up. It needs to do that before it can continue its bigger move in a healthy, sustainable way. And this right here is where knowing this stuff creates a massive shift in how you see the chart. When most retail traders see a pullback into one of these gaps, they panic. They think, oh no, it's a reversal. But traders who think like an institution, they see something totally different. They see the market rebalancing, and they look at that pullback as a golden opportunity to get into the main trend at a discount. So when you put these two mechanics together, the hunt for fuel and the need to fix unfinished business, suddenly everything starts to click. You stop seeing random noise and you start seeing a blueprint. This gives us a whole new framework for reading what the market is doing. With this new framework, all those things that used to be so personal and frustrating now become logical, maybe even predictable. My stop was hunted becomes, oh, a liquidity sweep just happened to fuel a bigger move. And why did price randomly reverse? Becomes, the market is just rebalancing an inefficiency. See? It totally changes the game.
All right, so let's boil it all down. What should you really take away from all this? First, the market isn't personal. It's mechanical. It's driven by two simple things, the need for liquidity and the need for efficiency. Price is drawn to those pools of orders like a magnet, and when it leaves a mess, it usually comes back to clean it up. That pullback you see, it's very often just a correction, not a full-blown reversal.
I love this quote because it just nails it perfectly. Our job isn't to be a fortune teller and guess where the market's going. Our job is to understand the mechanics, to see the blueprint, and simply react to the logical things that we see happening on the chart. It's a big shift from prediction to observation.
And that really brings us to the final question, the one you have to ask yourself. Now that you can see the machine, now that you understand why it moves the way it does, are you going to keep being its fuel, or are you going to start learning how to read its blueprint? Because that's the question that could change your entire approach to the markets.